and let's get started with what's happening in the markets. Now, what goes up fast can come down faster. South Korea's stock market just learned that lesson the hard way. South Korea's benchmark, KOSPI index, has fallen significantly after record-breaking rallies. Monday's crash brought in a big reshuffle. The Korean stock market fell as much as 10% on June 8th, triggering circuit breakers and halting trading. The culprits? The same two stocks that made Korea a global market darling. Samsung Electronics dropped over 10% and SK Hynix fell nearly 8%. Both stocks have declined 3 straight sessions since June 4th, losing 18% in that period. What triggered this crash? Well, Broadcom's earnings guidance fell short of market expectations, dampening investor sentiment. Strong US employment data also revived concerns about higher interest rates. That spooked global chip investors, and South Korea felt the full force of it. South Korea's total market cap has soared 86% this year to $5 trillion, overtaking India's $4.8 trillion to become the world's 6th largest stock market. Samsung and SK Hynix together account for roughly 50% of the entire KOSPI by market value. That concentration is now a crisis. The sell-off in Seoul has pushed South Korea's market value, restoring India to the 6th place in global rankings. That despite India's benchmark indices down about 11% in 2026. Global funds have offloaded around $26 billion worth of Indian equities this year. But India never had the chip-driven highs, and now it avoids the chip-driven crash. The lesson here is clear. When any fluctuations hit the chip market, the South Korean stock index will turn extremely volatile. A market built on 2 companies is a market built on risk. The real test is whether Korea can sustain its re-rating through genuine corporate governance reform. Until then, Seoul's rise and fall will move in lockstep with AI chips.